I graduated high school with honors. I could recite the causes of World War I, solve for X in a system of equations, and analyze themes in Shakespeare. Then I turned 23, got my first paycheck, stared at my pay stub, and had absolutely no idea what FICA meant, what a 401k was, or why my take-home pay was so much smaller than the number I'd negotiated. I had a diploma, a student loan I didn't understand, and zero financial literacy. And I wasn't alone. According to the TIAA Institute's 2025 assessment, American adults answered only 49% of basic financial literacy questions correctly, the exact same score as 2017. 8 years passed. The needle didn't move. Among Gen Z, it's even worse, only 31% can answer basic money questions correctly. Poor financial literacy cost Americans over $246 billion in 2025 alone. That is not a personal failure. That is a systemic one. And if you've been following Liana Invests, you already know that one of the things I'm most passionate about is making sure you don't pay that price. Today I'm breaking down the 10 money rules that every school in America should have taught you but didn't. These are the rules that would have changed my financial life if I'd learned them at 17 instead of discovering them the expensive way. Let's get into it. Rule number 1. Compound interest is the most powerful force in your financial life, and it works both for you and brutally against you. Schools taught us exponents but never showed us what an exponent does to money over 3 decades. Here's what that one missed lesson costs people. At 8% average annual returns, money doubles roughly every 9 years. If you invest $10,000 at 25, it becomes $20,000 by 34, $40,000 by 43, $80,000 by 52, and $160,000 by 61. You contributed $10,000. The market created $150,000. One class period, one chart. That's all it would have taken. The flip side is equally devastating and equally untaught. The average American carries $6,500 in credit card debt at 22.4% APR. Pay only the minimum and you end up paying over $15,500 on that original $6,500. The same mathematical force that makes investing magical makes debt catastrophic. Rule number 2. Every dollar has 2 prices, what you pay today and what you lose forever in compounding. This is opportunity cost, and it reframes every single spending decision once you understand it. A $16 lunch you could have made at home isn't $16. At 8% over 30 years, it's $160. A $7 daily coffee habit isn't $7. It's roughly $42,000 over 20 years. A $467 monthly gap between a new car and a used car isn't $467. Over 30 years of compounding, it's closer to $566,000. The entire consumer economy looks different when you see every price tag alongside its shadow price. I discovered this at 29 sitting at my kitchen table with a compound interest calculator, and I felt genuinely robbed, not of money, but of time. Rule number 3. A credit card is not free money. It is the most expensive money you will ever use. I got my first credit card from a table in my college cafeteria. A 21-year-old with no income signed a 24.99% APR agreement in exchange for a free t-shirt. That t-shirt cost me roughly $8,000 in interest over 6 years. Here's what no school ever explained. At 22.4% APR on a $6,500 balance, your first month generates about $121 in interest. If your minimum payment is $130, only $9 goes toward the actual balance. $9. Total U.S. credit card debt crossed $1.28 trillion at the end of 2025. 49% of Americans now describe credit card debt as normal. The normalization of paying 22% interest on last month's groceries is one of the most expensive cultural shifts of our generation, and it starts with a folding table in a college cafeteria. Rule number 4. Pay yourself first. This means saving before you spend, not after, not whatever's left over. The moment your paycheck lands, the first transaction that happens is a transfer to your savings or investment accounts. Everything else gets what remains. The U.S. personal savings rate sits at around 4% as of early 2026. 4 cents out of every after-tax dollar saved, 96 cents goes to someone else. That's what happens when saving is the last priority. When it's the first, your spending naturally contracts to fit the remainder. Vanguard's 2025 How America Saves report found that the people hitting strong savings rates are overwhelmingly those who automated their contributions and never touched them again. Set it up once. Let the system run. Rule number 5, an employer 401k match is free money, and not taking it is the same as declining part of your salary. A common match is 100% of your first 3% contribution and 50% of the next 2%. On a $75,000 salary contributing 5%, that's $3,375 per year in free employer money. If you're contributing below the match threshold, you are literally leaving compensation on the table. Unclaimed at 8% over 25 years, that annual $3,375 grows to roughly $237,000. $250,000 your employer was ready to give you that you declined because nobody explained a 401k at 18. I didn't fully understand matching until I was 26. I'll never get those 4 years back. Rule number 6, your credit score is a financial asset that directly controls the price of everything in your life. The difference between a 680 and a 760 score on a $300,000 30-year mortgage is roughly $70,000 in total interest. Same house, same loan, $70,000 more or less based on 3 digits. The 5 factors that determine your score are simple enough for a teenager to memorize: payment history, credit utilization, length of history, credit mix, and new inquiries. Keep utilization under 10%, pay on time, don't close old accounts unnecessarily, don't apply for 5 cards in a month. A 30-minute lesson that saves tens of thousands over a lifetime. I learned it from a blog post at 27 instead of a teacher at 17. Rule number 7, lifestyle inflation is the invisible force that keeps high earners broke. When my salary went from $42,000 to $55,000, my spending followed within 90 days. Nicer apartment, better car, upgraded everything. The raise vanished and I felt exactly as financially squeezed as before, just at a higher altitude. Researchers call this hedonic adaptation. The pleasure from the upgrade fades. The payment stays. A Ramsey Solutions study of millionaires found that 94% consistently lived below their means, and only 31% ever averaged 6 figures. They built wealth by sending every raise to investments, not lifestyle. That single behavioral shift, applied across a career, is worth hundreds of thousands. Rule number 8, debt is not normal. Debt is a product sold to you by companies that profit from your payments. Total U.S. household debt hit $18.8 trillion at the end of 2025. Credit cards, $1.28 trillion. Auto loans, $1.67 trillion. Student loans, $1.66 trillion. These aren't organic numbers. Banks earn interest on your debt. Credit card companies earn interest on your balance. Every institution in that chain has a financial incentive for you to borrow as much as possible and repay as slowly as possible. If school had taught me that debt is a product, I would have evaluated it like any other product. What does it cost? What does it do for me? Is there a cheaper alternative? Instead, I treated it like oxygen. Just there. Just normal. It is not normal. Rule number 9, insurance, taxes, and benefits are the operating system of adult financial life, and school sent you in blind. I filed my first tax return without understanding what itemizing meant. I didn't know contributing to a traditional 401k reduced my taxable income, meaning every dollar I contributed saved me roughly 22 cents in federal taxes. I didn't know a Roth IRA lets money grow and come out tax-free, arguably the best deal in the American tax code for someone in their 20s. In 2026, you can contribute up to $24,500 to a 401k and $7,500 to a Roth IRA. These limits exist specifically to give ordinary Americans a tax-advantaged path to retirement. They are also completely useless if nobody tells you they exist. I also didn't know renter's insurance costs $15 to $20 per month and would have covered $10,000 in stolen property when my apartment was broken into. Rule number 10. The biggest financial risk in your life is not knowing what you don't know. This is the rule underneath every other rule. The most dangerous financial position isn't being broke, it's being unaware of the mechanics that determine whether you stay broke or build wealth. When you don't know what you don't know, you can't see the trap before you walk into it. You can't evaluate a credit agreement or a loan structure because you lack the framework to distinguish a good deal from a catastrophic one. Progress is happening. 29 states now guarantee a standalone personal finance course for high school students, up from just 13 in 2022. Ohio's class of 2026 is the first to require financial literacy for graduation. More states follow in 2027, 2028, and 2030. But for the hundreds of millions of Americans who already graduated without this education, the damage has been done. The balances have been carried, the matches left unclaimed, the mistakes made and compounded. Here's what I want to leave you with: the fact that school didn't teach you these rules is a failure of the system, not a failure of yours. You weren't lazy. You were a student in an education system that decided mitochondria was more important than compound interest. But the system's failure does not change your responsibility going forward, because now you know. You know that compound interest works for you when you invest and against you when you borrow. You know every dollar has a shadow price. You know credit cards are the most expensive money you'll ever use. You know to pay yourself first and automate it. You know your employer match is free money waiting to be claimed. You know your credit score controls the price of your financial life. You know lifestyle inflation is the invisible wealth killer. You know debt is a product, not a necessity. You know taxes and insurance are the operating system of adult life. And you know the biggest risk is not knowing what you don't know. If this video helped you see money differently, hit that like button. It genuinely helps this channel reach more people who need to hear exactly this. And if you're not already subscribed to Liana Invests, subscribe right now because I upload every single day and every video is designed to give you the financial education that school never did. The compound interest on understanding works exactly the same way as the compound interest on money. It just needs time. Start now.